I'm with Christine Van Couwenberg, who is Vice President Tax and Estate Planning with Investors Group, and she's also the author of Wealth Planning Strategies for Canadians. Today we're going to be talking about transferring a vacation property to the next generation. Welcome, Christine.
Thanks very much.
So, given your expertise in tax and estate planning, I assume many clients will ask you about how to best pass on their vacation property to the next generation. Are you noticing an increase in the number of questions you receive on this topic? And if so, are there any particular reasons it comes up so frequently?
Planning for the transfer of a family vacation property has been an increasingly difficult issue for many families, and in many cases they feel that it's an important topic to discuss because they believe it will be the most difficult asset to transfer upon the death of a second parent. And in fact, there have been surveys that have indicated that many clients expect that there will be conflict over the transfer of this particular property. So it is important to make sure that you've incorporated into your estate plan. And there are a number of reasons why it's becoming so difficult. First of all, for many families, there's a strong emotional attachment to that particular property. So many children may already have a primary residence or may not be particularly concerned about how other assets are transferred, but they may have a very strong emotional attachment to that specific property, sometimes because they don't have a vacation property at all or because they want that specific property. Secondly, the values of many properties have increased dramatically across the country. And so when you're dealing with very, very valuable assets, and in many families you've got multiple children, how do you divide that property between several people? And the third issue often is the capital gains tax liability, which many people, quite frankly, aren't prepared for and don't realize is going to be there. So you have to be prepared for the fact that when you transfer that property or leave it to the next generation, there will be a capital gains liability, which is the difference between what you paid for it and what it's worth at the date of transfer. And so you've got these three big issues that you have to deal with, and quite frankly, it's the perfect storm.
You've referred to the tax issue, and I assume that must cause a fair bit of concern for clients. Could you explain to us how the tax is calculated, maybe in layman's terms, so that we can understand how it works exactly?
Well, the first thing I would emphasize is that there are always twists and turns for every individual, so you should always speak with your own tax accountant to make sure that you understand how the taxation will work in your specific circumstance. But generally speaking, the first tax that I think people really need to be concerned about is the capital gains tax, and that can be quite significant. And unless you're passing the property to a spouse or common law partner, in which case you can roll over the property, or you're designating it as your principal residence for the purposes of the principal residence exemption and completely exempting the gain, then unless you fall into one of those circumstances, there will likely be a capital gains tax liability when you transfer the asset. And people don't realize that it's anytime you dispose of the asset that this transfer could occur. So if you simply gift the property to the next generation, or even in some cases if you add a joint owner or you sell it, whether or not for fair market value, anytime you transfer the property to an arm's length person or non-arm's length person, you could be triggering the capital gain. And the way the capital gain is calculated is it's the difference between the fair market value and the cost of the property. So let's take an example of someone who's purchased a property many years ago for $150,000 and it's now worth $750,000. That means you have a $600,000 capital gain, 50% of which is taxable, which is $300,000.
Right.
So if you have to include $300,000 in your tax return on top of whatever other regular income you might have, you can see where you could quite easily end up in a very high tax bracket.
Correct.
So I usually tell clients to prepare for a 50% tax rate. So if you're paying 50% on the 50%, you're basically paying 25% of whatever capital gain may have occurred. So that can be quite significant. But I also just want to point out that if you have a capital loss, then you can't claim that capital loss against other gains, which is somewhat unfair. So if the property goes down in value, you can't claim the loss, but if it goes up in value, you have to report the gain.
Okay. So is there any way to minimize or even eliminate the gain?
Well, as I said, the way in which you calculate the gain is it's the difference between the fair market value and the cost base. So what I tell many clients is try and maximize your cost base as much as possible. And the way that you do that is you need to keep track of all the amounts that you've effectively invested in the property. So it's not just the amount that you necessarily originally paid for the property. It could include any capital improvements that you've made to the property since you first bought it. So I do recommend to clients that they always keep all their receipts for any amounts that they spend on the vacation property, whether that's putting in a new dock, renovating the kitchen, even just spending a couple $1,000s on lumber and doing the work yourself. You should be keeping all those receipts. Unfortunately, sweat equity doesn't count, so you can't increase the value by what you believe you've put into the property, but you can, as I said, increase the cost base by any capital improvements. So that's not day-to-day repairs, that's major lasting improvements. But I also, in fact, tell clients, make sure you keep your receipts for both properties, because if you have a home in the city and a vacation property and you decide to use the principal residence designation on one property, the vacation property, you then will want to make sure you increase the cost base on your other property. So make sure you keep all your receipts related to any of your personal use properties. In addition to that, I do recommend that you try and keep track of any historical transactions. So if you've inherited a property, make sure you kept the copies of whatever estate documentation there was indicating what the value was when you received it. If you bought the property from a family member, make sure that you keep track of that. If you've used the $100,000 lifetime capital gains exemption, which hasn't been around since the early 90s, but if you used it way back in the day, keep all those records and make sure that you keep all your documentation so that you are only truly paying tax on the real capital gain. You're not paying tax on more than you have to. But arguably the best way to eliminate the gain completely is to designate the property as your principal residence for the principal residence exemption, and you really should be speaking to your accountant as to whether or not that is the right decision if you have more than one property.
Okay, so it sounds like designating the property as your principal residence is the one method you can use to eliminate the gain. Are there things you need to keep in mind when making that designation?
Well, the first thing you need to keep in mind is whether or not you can actually designate the property as a principal residence, and that can happen so long as you ordinarily occupy the property. Ordinarily occupying the property doesn't mean it's your primary residence or that you even live there, the majority of the time. It just means that you go there from time to time and you do occupy it at some point during the year. So I think that you need to speak to your accountant and make sure that it does qualify as a principal residence, because it can't be vacant land, it can't be rental property, that sort of thing. But assuming you're dealing with a property that you do occupy on a regular basis, then I think that it's important to understand how the calculation works. And a lot of people make certain assumptions as to how they think it's going to work. And I think the best way to explain it is usually through an example. So let's say you purchased two properties at the same time, and you lived in one home in the city and you had one vacation property, and you lived in both of them, or you occupied both of them for 10 years. And then you sold the home in the city because you wanted to retire out to the vacation property. Well, at that point, if you designate your home in the city as your principal residence, then the full amount of the gain can be exempt because you've lived there for 10 years and you can designate it as your principal residence for 10 years and not pay any tax. If you then move out to your vacation property, though, and live there for another 10 years, and you sell that property at the 20-year mark, there are many people who think, well, at that point, I can claim that property as my principal residence in that year, and the full amount will be exempt. But that's not the case, because you've already used up 10 of the 20 years of ownership, and it's actually a relative situation where you have to figure out, okay, how many years am I going to designate it as my principal residence, divided by how many years have I actually owned it, and in that case then only a portion will be exempt, and that's the mistake that many people make. But I also recommend that people have a full understanding of how it works, because the equation in fact includes a +1 in the numerator, which gives you an extra tax-free year. The +1 is not available if you were a non-resident at the time you acquired the property. So that's another little wrinkle that you need to keep in mind. And the federal government changed those rules in the fall of 2016. So again, I do recommend that you speak to an accountant. But assuming you're a Canadian resident, going back to our example, if you purchased two properties in 1 year and you lived in the first one for 10 years, I would actually only designate it as your principal residence for 9 out of the 10 years, because you get 9 plus 1 divided by 10, the whole thing is exempt. Then if you move out to the second property and you live there for another 10 years, so you've lived there for 20 years, you've got 11 years that you haven't designated yet. So 11 plus 1 is 12 divided by 20. That means 60% of the gain will be exempt, 40% will be taxable. But since it's only 50% taxable to begin with, you're looking at 20% of the gain. So that's how you can hopefully manipulate the use of the principal residence exemption to minimize the amount of tax you'll pay.
I'll be honest, it sounds a little complicated. Is the process quite involved?
We always recommend that clients speak with an accountant when using the principal residence designation because it can get fairly involved. And in fact, the federal government changed the rules in the fall of 2016 because they felt that many people were not reporting the gain properly. And many people, quite frankly, didn't understand how it worked. And they just honestly thought that they could claim multiple residences, or maybe one spouse could claim one property and the other spouse could claim another, when in fact you can only claim one designation per family unit, which is both spouses and your minor children. So, it wasn't anything intentional. It's just people were not properly reporting these amounts. So now the federal government has said anytime you dispose of any property, whether it's a home, a vacation property, any personal use property, you need to report that on your tax return and properly designate it, or you won't be able to use the principal residence exemption. And this is a relatively new rule, and I know that in many cases people haven't been reporting the sale or transfer of their homes because they felt that there was no tax to report. But quite frankly, that's not the rule anymore. Whether or not there's tax to report, you need to put that in your tax return. And I'm just concerned that there will be clients who will be caught off guard by this and not understand the new rules. So it's very important to make sure you properly report it.
When we first started talking about taxes, you mainly spoke about capital gains tax. Are there other types?
Yes, well, I usually start by talking about capital gains tax because, as I refer to it with clients, that's the big tax. And there are, in fact, a couple of taxes you need to keep in mind. So capital gains tax is the big tax, which is usually in the 50% range. But there is also what I refer to as the little tax, and that's probate fees. And ironically, for most people, they're most concerned with probate fees, even though in most jurisdictions they're less than 1%. There are only 3 provinces where probate fees are over 1%, and that's BC, Ontario, and Nova Scotia, where they're still only 1.5%. But in most jurisdictions, as I said, they're less than 1% and basically non-existent in Alberta and Quebec. So I know that a lot of people are very focused on that because they've heard about probate fees. They're in fact known as estate administration taxes in Ontario, and they may have administered another estate where there were these probate fees, and they think, oh, well, I want to avoid these, and they think it's pretty simple to do so by adding a joint owner or in some cases a direct beneficiary on some types of products. So they're really focused on saving, as I said, the little tax, but they don't realize that when you add a joint owner or you transfer the asset prior to the time of death, you could in fact be causing a different type of problem, and that's potentially triggering the big tax. And for a lot of people, they don't realize that there is this capital gain liability, maybe because they received the property from their parents prior to the early 90s when they could use the $100,000 lifetime capital gains exemption. Maybe it was transferred from a spouse on a rollover basis. They may just have never experienced this before. Maybe they've never had 2 properties. So if you have one property, you use principal residence exemption on the other, and you just don't realize it's there. But if you have 2 properties and you've owned them for an extended period of time, you do need to be prepared for the big tax, which is capital gains.
So assuming there will be a capital gains liability, what would be the best way to plan for it?
What I usually tell clients is you need to sit down with your financial planner and figure out what your estate is going to be worth on an after-tax basis and figure out what the capital gains tax liability may be. And although there may be some things that you can do, as we've discussed, maybe use the principal residence exemption or try and maximize your cost base, usually what you really need to think about is funding the tax. And that's where it gets to in most situations. You can try and limit or reduce the tax, but if you have 2 properties, it's only going to get you so far. So you really do need to think about funding that additional gap, and usually that's through the use of insurance. So you want to make sure you do that planning while you're still young and healthy enough to obtain the insurance at a reasonable cost, because for most clients, that's the best option.
Okay, so assuming we've planned for the tax, are there any other concerns that clients should be aware of as they transfer their property, their vacation property, to the next generation?
Well, when families are trying to figure out how to pass this property on, assuming they have dealt with the tax issue, then some other pretty fundamental issues do come up in terms of how they're going to pass it on to the next generation and which child or children are going to use the property. And I do think it's very important for clients to sit down and have a family meeting to discuss some pretty fundamental issues. So for example, who is realistically going to use this property in the future? There are many situations where children regularly come to visit their parents at the cottage or vacation property on a regular basis because their parents are there, but once their parents pass away, they may prefer to take their portion of the estate and invest it in a vacation property in a location closer to where they live. So their parents may be under the assumption, oh, they love the vacation property, they want to keep it, but they may just be going there because the parents are actually there. Then you also need to give your children a realistic idea of how much the property costs to maintain on a regular basis. Passing it on is one thing, but keeping it long-term is a different issue altogether. And I think that in some cases, parents are under the impression that their children are doing very well financially, and they may be doing okay, but they may have a lot of debt or other issues in their life, and they just can't afford to keep the cottage because it just costs so much to maintain. So you need to find those things out well in advance. And thirdly, I think it is just important to simply ask who's interested in the cottage, because I have seen situations where people have said in their will, I'm absolutely leaving this property to both my children or all of my children, and they're going to share it. And it turns out after the time of death, one wants to keep it, but the other one really wants to sell. And it's an immediate source of friction and tension. So I wouldn't tie people's hands too quickly. You want to make sure that you find out what your children's interests are before you put a plan together.
So what guidance would you give to clients who are grappling with all of this?
Well, as I said, I do think it's very important for clients to sit down as a family and discuss it, and even better, sit down with some third-party advisor, a financial planner or a lawyer or an accountant, and work things through before making any rash decisions. I have seen situations where clients just very quickly decided, I have to deal with this, so I'll just add on a joint owner of my cottage, because they thought that that's how they needed to deal with things in order to deal with their interpretation of what the tax problem was, when in fact, it's, as I said, it's not a probate fee issue. Usually it's an income tax problem in the form of this capital gains liability. So, don't do anything rash, because when you're trying to figure out how to distribute your estate, then it becomes very complicated. Okay, you added this child on as a joint owner to this property. What did you mean by that? Are they receiving that property now in addition to their share of the estate, or is that part of their share of the estate? It just makes things very, very complicated. And what happens if the child's life doesn't work out quite as you intended? They go bankrupt, they get separated or divorced. I think a lot of clients come to regret making those sorts of rash decisions. So as a general rule, we wouldn't recommend joint ownership except in very rare circumstances. So assuming you don't add a child on as a joint owner and you don't transfer your assets prior to the time of death, if you're doing an estate plan that just involves transferring assets as part of your will, what we generally recommend is that you simply designate in your will that each of your children will receive an equal portion of the estate. We don't recommend that you pick favorites, so to speak, and dictate who will receive what, because that's what leads to arguments, particularly when assets are worth more or less than what you thought they would be worth and you haven't incorporated the capital gains liability, and it just becomes very difficult at the time of death to keep everything fair. So what we recommend, as I said, just leave your estate to your children equally, and then allow them to effectively notionally buy the assets that they want from the estate. But if they are going to want a very large asset, obviously they need to be receiving at least as much from the estate as that asset is worth, and that's where the planning comes in. So we recommend to clients that they sit down with their financial planner and figure out what is the true after-tax value of my estate, because that's the part that a lot of people don't have a clear appreciation of. So for example, let's say you have someone who believes their estate is worth about $2 million. They have a home, they have a vacation property, they have some other investments. Well, if they have 3 children and they want them each to receive 1/3 of the estate, and one of the children says, you know what, Mom and Dad, I really want that vacation property. Well, that's important information to know. I still don't think you should dictate that in the will, but you want to make sure, okay, that child's portion of the estate hopefully will be worth at least as much as the vacation property. So how much is that vacation property worth? Let's say $600,000. Well, If the estate is worth $2 million and the property is worth $600,000, which is obviously less than a third, that child can choose to take that asset, and everyone else will also receive their third, and things will probably go fairly smoothly. The problem is your estate really worth $2 million after tax? And I'm talking about the big tax, not the little tax. And that is where you do need to sit down with your financial planner and do some projections. Because I've seen situations where people think, oh, I have a $500,000 RSP, so I'll include that in the number. Well, actually, when the second spouse dies and you transfer those assets to the next generation, the tax bill cracks open, so to speak, and a $500,000 RSP may only be worth $250,000. So you start adding up those various tax liabilities on your assets, and it can come to a fairly big number. So what if your $2 million estate is actually only worth about $1.5 million after tax? Okay, now each child is entitled to $500,000 worth of value, but one of your children wants a $600,000 asset. How does that work? Well, that's where you probably need to ensure the difference. So if you're looking at it from the child's perspective, they're saying, oh, well, I want a $600,000 asset, but I'm only getting $500,000. I need $100,000 worth of insurance. If you're looking at it from the parent's perspective, though, they'll probably say, well, I want to leave each of my children $600,000 then, so I need $300,000 of insurance to fund the gap and bring it up to the level that I think is appropriate to make sure that everyone's goals are achieved.
Are there any situations where it might make sense to transfer the property to a child before the parent dies?
Although there are limited circumstances where that may make sense, I do caution clients a fair bit before transferring an asset to a child prior to the time of death. I think that many people come to regret transferring a property too soon, and so you really do need to think about it. And there are a couple of particular issues that you should consider. First of all, as I've already mentioned, anytime you transfer a property to a non-arm's length individual, a child, you are going to be deemed to have triggered the capital gain, and so you will have to pay that capital gains tax liability regardless of whether or not you've actually received any money for the property, which comes as a surprise to many people because they think that it's just an innocuous thing to do. But if you are gifting a property to someone, you will still be deemed to have received fair market value, and so you have to report that capital gain and pay that tax even though you don't have any cash with which to pay the tax. And the second problem from a tax perspective is that if you're over the age of 65 and receiving old age security, that huge lump sum of the capital gain could in fact result in OAS clawback for you. So a lot of people don't realize that, and it's a very unexpected surprise. So think about that before you transfer property. The third thing you really need to think about is the fact that you will be giving up control over this asset. And I think that a lot of people don't really think about what that means. In some cases, parents just want to add a child on as a joint owner, thinking that's an innocuous thing to do. But even having a joint owner there means that you need that person's permission anytime you want to mortgage the property, sell the property, deal with the property. And for a lot of people, that comes as a nasty surprise because they're not thinking about that. They think it's just there for succession planning purposes. They don't realize that they're actually giving up some control now. And what if the child has something unexpected happen? They suffer a separation or divorce, or they go bankrupt. Those are things that you really need to think about. And if you are actually gifting the property, then you have no control over the asset. They could sell it, they could mortgage it, do whatever they want with it. So you really do need to think very carefully about that. But obviously, in some limited circumstances, there may be situations where parents are willing to give away the property. In those situations, I just caution that you want to make sure you're treating everyone equally. If you're going to give, let's say, a $300,000 vacation property to one child, hopefully you're not doing that unless you're also in an equal position to give away $300,000 of assets to another child. And not everyone is in the position to start giving away that many assets. You have to be a fairly high net worth to be able to give away all those assets and treat everyone equally.
If one of the children really wants the vacation property and the parents are ready to part with it, is it possible for the child to buy it?
Yes, if the child has the ability to buy the property, particularly for fair market value, that can really be an effective strategy for a number of families. And if the child pays fair market value and has cash, then the parents have the means to pay the capital gains liability. So that takes care of that situation right there. But I do think that it is important to make sure that the sale is still structured properly. So if you want to sell the property for less than fair market value, I would make sure that you exercise a fair bit of caution and understand that that could in fact trigger double taxation. So let's say someone purchased a property for $100,000 and it's now worth $500,000. If you sell that property to your child for $500,000, that will trigger a capital gain of $400,000. If you sell it to them for $100,000, that will in fact still trigger a gain of $400,000 because you're deemed to have received the full fair market value. The problem is when the child sells the property later, their cost base is $100,000. It's only what they paid. So you're better off just structuring it as a sale for fair market value, even if the child's not able to pay the full amount, and take back a promissory note, which then can be forgiven at the time of death. But the other good thing about that is because there's this promissory note, that can be taken into account when you're distributing the rest of the estate. And so the other children know, okay, look, you still owe the estate effectively $400,000. So we're each going to take that amount first before you get any additional amount. So a sale for fair market value can be effective in some circumstances. I also know situations where multiple children have wanted to buy the property from their parents. And that can work, but that does have additional risks. And I do think that the children in that case need to think very carefully about whether or not they want to enter into a joint ownership arrangement with a sibling. It can work well, but it can be very messy. And I don't recommend it unless you have some sort of co-ownership agreement signed in advance, indicating what will happen at certain key events. So for example, if one of the siblings passes away, are you then going to co-own it with your brother-in-law or sister-in-law or their children, or are they going to be bought out using insurance? What is the plan? Because a lot of times people don't think these things through, and it can cause a lot of resentment and tension.
I assume it might be difficult for the children to come up with such a large amount at once. Are there strategies they could use to facilitate a sale?
One strategy that we sometimes recommend to clients is to spread the sale out over a 5-year period. And that's because there is a provision in the Income Tax Act that allows you to take a capital gains reserve. So that might be something to consider if the children are having difficulty coming up with one lump sum. And it also allows the parents to spread the capital gains tax out over a 5-year period. But the provision does require that you report a reasonable amount of the capital gain in each year. So the minimum amount you have to report is 20% per year. But if you receive more than 20% in any one year, so let's say you receive 50% in the first year, then you would have to report 50% of the first year and then the remainder of the ensuing years. But the one potential drawback for some clients is if you're over the age of 65 and receiving old age security, then instead of having your old age security potentially clawed back in 1 year when you receive a huge lump sum, it's possible that it might be clawed back for 5 years when you're receiving smaller lump sums, which are still significant. So you need to make sure that you speak to an accountant before implementing that strategy, because it may or may not be the best strategy for you.
So Christine, if we were to sum it up, for the vast majority of people, what's the basic message?
Well, I think for most families, they really just want to treat their children equally. And so that's what we recommend we put in your will. Just leave your estate to your children equally, and don't set things out in stone too much, indicating who will receive what or when, because people change their mind, and the children, may or may not change their mind over the course of time. So what you really want to do is sit down with your financial planner and figure out what your estate will be worth on an after-tax basis. And if it's not going to be worth as much as you thought it would be worth, and the full value isn't going to be sufficient to allow whichever child might want to take that asset to actually buy it from the estate, then you may need to insure the difference. And so as long as there's enough liquidity to give the children options, you're usually going to be in a much better position. So make sure that you've spoken to the children, you know what their objectives are, and there's enough money there to make those things happen. Now, if multiple children, in fact, want to take the property, that's where it can get a little bit more complicated. So we do recommend that the children sign a co-ownership agreement before they take title and understand what joint ownership really means, because again, I think a lot of people just assume, oh, it'll all work out, but in many cases it doesn't. So you need to be proactive. Sit down with your family, sit down with your financial planner, make sure your plan is in order, and hopefully if you do all those things, there won't be any nasty surprises.
Christine, I want to thank you for sharing your knowledge with us today.
Thanks, it's been my pleasure.